Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Every week we're seeing more stories about AI, artificial intelligence, ChatGPT, Google Bard and the rest of them. Some of the reports are a little alarming, like the industry experts calling for a pause on developing the technology, or Alphabet boss Sundar Pichai admitting the tech keeps him awake at night. But clearly it's here to stay. So how should investors think about it? Where are the opportunities in this fast-changing space? Remember, this is general information only, and you should seek professional advice before making any investment decisions. Chris Brycki is the Chief Executive Officer of online investment advisor Stockspot. Pretty much a regular Chris at Fear and Greed, wouldn't you agree?
It feels like it. Yeah, it's great to be back again.
We appreciate it. Now, look, let's start with the basics. When we're talking about AI, what are we talking about?
So yes, it's a term that I think a lot of your listeners will be hearing a lot more these days. But AI, or artificial intelligence, it's basically a type of computer software that's designed to learn from data and then use that to make decisions based on that data. So similar to the way that like we would make decisions as humans, we learn from experience. AI also learns from experience.
Okay, so the main example listeners will have heard of and maybe used is ChatGPT. But it's always learning. ChatGPT itself is always learning. So it's never static, this whole area, is it? Nor is ChatGPT.
Well, that's right. I think even before ChatGPT really came onto the scene towards the end of last year, 2022, I think a lot of people would have already experienced AI in their lives. If you've used a voice assistant like Siri or Alexa, or use chatbots online, a lot of these already use AI. But the big innovation that happened and really accelerated last year was around what we now call generative AI, and these are new methods of AI that basically aren't just, responding to messages or this sort of thing, but they're actually able to create new content. And that's what's really quite fascinating with some of these new software programs, that they're intuitive, they're easy to use, and they basically have the ability to generate new and amazing content.
If you're like me and you think, wow, this is something that for right or wrong is going to grow, and you're thinking about investment opportunities, how do I get involved? How should I start thinking about that?
Well, it's very difficult, I would say, Sean, to know exactly what's going to happen. Like with any new innovation, whether it was the internet or the iPhone, innovation tends to happen in waves. It comes in leaps and bounds, and then it sort of doesn't happen for a while. I think this will be one of those big innovations. But when the internet came out, or the iPhone, it was quite hard to predict what were the websites that were going to be successful, or what were the apps. There's a lot of ideas that I'm sure haven't even been thought of now that will end up being the enormous successes that come of this. So as an investor, it is quite hard to predict. And there's certainly some companies whose share prices have either rocketed due to their involvement in AI over the last 6 to 12 months. Interestingly, there's also now been a few share prices that have crashed because they've said that their companies have been impacted by people using these AI tools like ChatGPT instead of their own services. And there was an education business last week in the US whose share price crashed when they announced their earnings had fallen because people weren't using their program as much. So our general recommendation to our clients is to continue to invest in a very broad way, and because next year's winners may be, companies that haven't even been discovered yet.
When you invest in tech companies, or really industries where the pace of innovation is so fast, are there any sort of ground rules that you should think about? Is it about diversification? Is that kind of the basic one? How can you think? I mean, it's a bit like cryptocurrencies not that long ago. If you believed in cryptocurrencies, how did you know what to choose, for example? There's many examples over decades, but how should the people think about it?
The problem with trying to pick the winners in any new technology is you might get the overall trend right, or you might predict that, this is going to be transformative, but you might not actually pick the winners correctly. And I think, a lot of people have done that and lost money in the cryptocurrency space, thought that they were on to the next big winner, but it ended up, not doing anything or going backwards. The same I remember in the early technology days. I was trading shares as a young teenager in the day and thought some of the companies that I'd identified were going to be the big winners, but they ended up not being so. So, my view is that actually index funds are a great way of investing in the big trends of the future. And I know I mentioned index funds quite a lot on your show and ETFs. The reason why they help you get into the big next trends is when companies are doing well with an index fund, the index fund puts more and more weight or more money in those particular companies. And so if you've got businesses that do better and better over the long run due to AI, you'll see them becoming a bigger and bigger part of the portfolio. And so you'll definitely have exposure to those companies. Whereas those that don't succeed or wither away, they'll be down weighted or you'll have a smaller allocation to those companies. So index funds are actually quite smart. They allow you to keep on increasing your exposure to successful sectors.
Are there any artificial intelligence index funds out there at the moment?
Interesting question. So in Australia, there aren't any that specifically invest in AI only. However, over the last 5 or so years, there's been a whole bunch of new ETFs that have come out to focus on more specific niche areas. And there's a couple that are quite close to AI and certainly have a lot of AI involved companies in them. There's one ETF called the Global Robotics and Artificial Intelligence ETF, and its ASX code is RBTZ. And it certainly has a lot of companies in that ETF that are involved in this space. The other one is the Global Robotics and Automation ETF, and its code is ROBO. And both of these, have a bunch of companies within them that are exposed to this area. But the big question does still remain, will these be the successful companies of the future, or there'll be other companies that will be the winners?
And so in terms of specific companies, there's not a lot of local opportunity?
Not so many in Australia. So none of the really big, large caps, I would say, are pure play AI businesses in Australia. There's certainly a bunch of technology companies that talk about how they're either using it within their businesses or they're involved some way or another. There are a few bigger companies in the US that have quite a lot of involvement and have seen their share prices do quite well, off recent news. So there's a company in the US or on the NASDAQ in the US whose code is NVDA, NVIDIA, that has done very well out of it. But even some old businesses like IBM and Microsoft, are performing relatively well on the opportunity that AI is presenting them.
Stay with me, Chris. We'll be back in a minute. My guest this morning is Chris Brycki, Chief Executive of online investment advisor Stockspot. What's the biggest risk, do you think? I mean, apart from picking so let's say you go into an index fund, which gives you exposure, so you're diminishing the risk of not picking the right company. What is the big risk of this?
I mean, the big risk of AI, if you believe people like Elon Musk, is that it might destroy the world. But if you put those risks aside and you're specifically thinking about investment risks, the risk is, I would say, a similar risk to what we saw in 2000, where an area like the internet, ultimately is going to be a game changer, but too much money goes into it too quickly. And it takes, and for the internet businesses, back in the day, like Amazon, it took a long time for their share prices to recover from the boom and bust cycle they went through. So the big risk for investors is you actually pick the right companies and the right trend, but your timing is wrong. And I saw a lot of people do that back in the early 2000s. Amazon is such a brilliant example. Amazon, obviously one of the biggest companies and most successful in the world now, but between 2001 and 2002, its share price fell 96% from its high. So it was very difficult for someone that had a big exposure to Amazon in their portfolio to hold on through that turmoil. And so, I think the great lesson for that is to make sure you are diversified and you don't have too much exposure to any one company, because even if your end result is right, you might never get the opportunity to hold on that long, because it's a pretty tough conversation to have with your partner when you've lost 96%.
Now, Chris Brycki, CEO of online investment advisor Stocks. I'm just going to move on very briefly. The market at the moment, it's kind of interesting. We're getting to this peak in interest rate cycle, and inflation seems to be coming off the boil. Globally, what do you think the outlook for markets are? And I suppose, how do you invest in a market where interest rates are peaking?
I think you've nailed the answer in your question, Sean. I think the markets are driven by narratives, and the narrative at the moment is that the interest rate cycle is peaking and that inflation is coming down. So, if that trend continues, then you'd expect, markets to, remain, pretty happy with that outcome. Probably the big risk at the moment is that markets, have become a bit complacent and expecting inflation to continue to fall, and for interest rates not to need to go up much further. And I would say at the moment that's the bigger risk for markets, is that investors are underestimating, what interest rates are required in order to bring inflation down to the level of 2 to 3% that central banks are targeting. And looking back at history, it's been difficult historically to get inflation down unless interest rates come up above the inflation rate. And certainly in Australia, the interest rates are well below the inflation rate we're seeing at the moment. So for me, that's probably the biggest risk at the moment, is that inflation stays higher than people expect for longer, and interest rates need to keep on coming up to have an impact.
Chris, thank you for talking to Fear and Greed.
My pleasure. Thanks for having me back on.
That was Chris Brycki, CEO of online investment advisor Stockspot. This is the Fear and Greed Daily Interview. Remember, this is general information only and doesn't take into account your personal circumstances. You should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.